One fund on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, this is the ETF of the Week, where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we talk about here. Todd Rosenbluth, great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the PIMCO Multisector Bond Active ETF, PYLD.
PYLD, the PIMCO Multisector Bond Active ETF. And if that sounds familiar to folks, well, it was just over a year ago. It was in March of 2024 that you made this the ETF of the week. And it is very unusual for you in your time doing ETF of the week, but even before that, for us to have things that come back, especially when it's only been a year. But the fund was pretty new then. Why is it back now?
So it's doing really well. PYLD in the past year is outperforming the index that we think is appropriate. It's outperforming many of its actively managed fixed income peers. And this is an environment where we still believe active management makes sense. We've talked about active management in the short-term space. We thought a core plus strategy would be appropriate. And we're going to be talking with the team at PIMCO during VettaFi's upcoming income symposium in about a week's time.
In terms of this particular fund, one of the interesting things to me is that more than some bond funds, especially those that are not multi-sector, this fund took it on the chin when we had the tariff announcements. Like basically April the 4th, it had a nosedive. If you followed a 200-day moving average, it fell below its 200-day moving average. It has now recouped all of that and has actually gone above its 200-day moving average. So this fund seems to be a little more news sensitive and volatile than some other bond funds. So even though it's done well, that news sensitivity at a time when, wow, the market is very sensitive to news.
So listen, I think investors should have both risk on and risk off fixed income exposure. This is a bit more risk on. This is an income strategy. It takes on some additional risk to get roughly a 6% yield. You get the benefits of active management with a skilled team. This is PIMCO that's behind this. And Dan Iverson, who runs the PIMCO Income Mutual Fund, which is a several billion-dollar and tens of hundreds of billions of dollars, I'm sorry, I don't have the numbers in front of me right now, mutual fund that's running a slightly different version of the strategy. We've got expertise behind this. If you're willing to take on a little bit risk for that income, this is a great fund. And I don't think a day or a week or period of time is the right way to judge a bond mutual fund. In the past year, since we've been here, it's up 9%. It's outperforming its Morningstar category. This year is outperforming its Morningstar category all of last year. This is a strong fund, even though it doesn't yet have a 3-year track record. And real quick, if I can, it's gathered $2 billion this year. That's also what caught our eye. So it's nearly doubled in size in just the 4+ months, or not even 4 months of the year. This is a great strategy for folks that are looking for active management within fixed income.
So let's talk a little bit, because we do with ETFs of the week, about where something fits in a portfolio, because this is active and multi-sector. So this is a case where if you've got index funds, you might be looking for active management. If you've got treasuries, you're looking for other things. But if somebody's got any multi-sector exposure, or if they want to have control and say, I want to know how much I've got in high yield versus munis versus whatever, this would, does this not always play well with what else you might have in a portfolio?
Yeah, so you have to believe in active management to want to invest in this fund. You have to believe that the bond market is more volatile, more complicated, isn't necessarily for you to try to navigate on your own. But this can play nicely with other funds. We're actually going to be talking about this strategy and talking with WisdomTree, who's behind that fund we talked about last week, USFR, on our income symposium. One is obviously a risk-off Treasury strategy, this PIMCO fund, PYLD, is a bit more risk on, but the benefits of diversification, say that twice, I just did. The benefits of diversification shines through with this ETF. You have exposure to all the tools that are in the fixed income universe with an experienced management team behind it.
I know you like the performance of this fund, but since it is an income driving strategy, we should talk what's its current yield. And some people have told me that I don't ask you often enough about expense ratios. And bond funds, when they're based on indexes, are notoriously cheap. This expense ratio a little bit higher. Obviously, you feel that it's worth it, but do you have a limit on how high you're going to go on an active bond ETF when it comes to expense ratios?
So let me do the first part first, the second part second, perhaps. The yield on this is roughly 6%, which is compelling, certainly in this environment. The expense ratio is 55 basis points. This is active management. So if you don't want active management, you want a low-cost index core-based product, there are products from iShares and Vanguard and State Street, among others, that you can get for less than 10 basis points. This fund is outperforming its benchmark, an index-based product from iShares that I pulled up beforehand, IUSB, by about 200 basis points in the past year. That's net of fees. So to me, in this case, it's worth it. Not every active fund is worth it. Not every active fund is in that 50 to 60 basis point range. That's probably a good range for fixed income. But yeah, it's quite possible we'll come back and talk about a fund that is less expensive or more expensive. Fees do matter. They're not the only thing that matters.
Yeah, that's part of why ultimately, there's that mixed bag about talking about it. On the one hand, fees are guaranteed and returns are not. On the other hand, yeah, you're paying more and you can hate to pay more, but you're getting better returns. At least you have been on this fund since it opened. That's worth doing. So it's a balance, isn't it?
It is. Look, sometimes I want to eat a cheap meal that's fast and easy, that's prepared quickly, and I don't care as much. Other times I want something where I want the experts cooking the food, the right style for it. That, I think, is a good example of what PIMCO brings to the table, pun intended. PIMCO brings a lot of expertise to the table. 55 basis points is worth it for this fund, how it's performed so far.
And in this case, we definitely can smell what you are cooking. It's the PIMCO Multisector Bond Active ETF, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff as always. We'll talk to you again next week.
Yeah, let's see what we're having for lunch next time.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. And I am Chuck Jaffe, and I'd love it if you'd check out my hour-long weekday show at moneylifeshow.com or by going wherever you find your favorite podcasts. And if you're looking for information on your favorite ETFs or what might be your next favorite ETF, make sure you check out VettaFi.com, where they've got all the tools you need to be a better investor. They're on Twitter or X at Vetta_Fi, and Todd Rosenbluth, their head of research, my guest here on the ETF of the week. He's on X as well at Todd Rosenbluth. We've got the ETF of the week for you every Thursday. Make sure you don't miss an episode by following along on your favorite podcast app. And if you like us, leave a review or a comment, because those things really do help. We'll be back with another interesting and intriguing ETF for you to consider next week. Until then, happy investing, everybody.